On January 20th, 2026, something broke in one of the world's most boring financial markets, and almost nobody noticed. In Japan's government bond market, a mere $170 million in trades triggered $41 billion in losses across the yield curve in a single day. That's not a typo. That's how fragile it had become. Japan has the highest debt to GDP ratio of any developed nation on Earth, over 260%. For decades, they managed it with one trick: keep interest rates at zero. The Bank of Japan would buy its own government's bonds to suppress yields artificially. It worked. Until it didn't. In January 2026, Japan's 40-year government bond yield exploded to 4%. The 30-year moved 25 to 30 basis points in a single session, its largest one-day move since at least 1999. Traders on the floor described it as pure chaos. Here's why that matters. The Bank of Japan spent years buying its own bonds to keep yields pinned near zero. It now owns over half of all Japanese government bonds ever issued. When it started pulling back, letting the market set prices, there was almost nobody left who knew how to trade these things. The market had been on life support for so long it forgot how to breathe. The moment the Bank of Japan stepped back, even slightly, yields lurched violently. Liquidity had quietly evaporated over 2 decades of central bank dominance. Now comes the global part. Japan is not just any country. Japanese institutions, pension funds, insurers, banks hold roughly $5 trillion in foreign assets, mostly U.S. treasuries, mostly European bonds. They parked that money abroad because domestic yields were zero. That calculus is now reversing. As Japanese yields rise, those institutions earn real returns at home for the first time in 20 years. So they sell foreign bonds and repatriate the cash. When Japan's biggest investors exit U.S. treasuries, U.S. yields rise too, almost immediately. It happened in real time. The day Japan's bond market convulsed in January, the U.S. 10-year Treasury yield jumped 6 basis points. The 30-year approached levels not seen since before the 2008 financial crisis. German bonds moved the same day. This is financial contagion, not through banks collapsing, but through capital quietly flowing home. And underneath all of this sits the yen carry trade, one of the biggest leveraged positions in global finance. Investors borrowed in cheap yen and deployed that capital into higher-yielding assets worldwide. As Japanese rates rise, that trade unwinds. Forced selling everywhere, simultaneously. The last time the carry trade partially unwound, August 2024, global markets dropped sharply within days. That was a partial unwind. What's building now is structural. Japan issued 29.6 trillion yen in new bonds for fiscal 2026 alone. The supply is relentless. And the BOJ is still stepping back. Here is the trap Japan cannot escape. If yields rise, debt servicing costs explode on 260% of GDP in debt. If the BOJ steps back in to suppress yields, it destroys the yen and reignites inflation. There is no clean option left. Only the order in which the pain arrives. The world's third largest economy, sitting on the world's largest debt pile, with $5 trillion in foreign assets that are starting to come home, and a bond market that just showed it can move $41 billion in a single session on $170 million in trades. If you're not watching Japan, you're not watching the right thing. Subscribe, this one is far from over.